Welcome to Dad Gives Advice. My name is Orestes, and in this video I'm continuing my series on investment vehicles or securities. I want to talk today about mutual funds and what they are and how they work. This is another one in my series of things I wish I'd learned a long time ago. When I first started investing after college, when I got my first real job, I did a lot of investing in individual stocks, and I didn't really learn about mutual funds, or maybe they were like a distant thought. But I didn't really understand them and learn about them until much later in life. And that's why I want to put this information out there, to get that information to younger people earlier in their life so they can make better and more informed decisions. When I was younger and investing in stocks, I hit on some but missed on a lot more of them. And my overall returns were not great. And I think I would have done a lot better had I just started with mutual funds from the beginning. Before I get started, I'll remind you that the information that I present here is all for generic and informational or educational purposes only, and it is not intended to be individual advice to the viewer. Everyone's situation is very different when it comes to investments and which investments make more sense for each individual. And so you should work with an investment advisor before taking any action. So let's talk about mutual funds. Mutual funds are also known as pooled investments. And that just means that if you're buying into a mutual fund, you are buying into a basket of securities. And I'm just going to talk about stock mutual funds when I talk about them in general, but I'll get into it in a little bit. You'll see that there's all different kinds of mutual funds, not just stock funds. But for the purposes of the introduction and make it easier for me to talk about it, just focus on stock funds. So pooled investments, meaning that when you buy into a mutual fund, you're actually buying into a basket of securities, a basket of stocks, and not just one or two individual stocks. So let's look at that from a concrete example. So if you had $3,000 to invest, let's say you're starting out, and you've saved $3,000 and you want to invest that money, you have a few options, more than what I'm about to do here, but let's say a couple of those options are you can buy a stock or two. Let's say you can buy one stock for that $3,000, or you can buy a mutual fund that holds many stocks. So some mutual funds will hold dozens or hundreds, let's say 500 stocks. Some of them will hold 2,000, 5,000 stocks if they track the whole market. And so you can see immediately that the difference between putting all your initial investment dollars into one stock versus a mutual fund that holds many stocks is diversification. That is one of the benefits, diversification. And in this case, diversification means if all your money is in that one stock, let's say option A there, you're going to be at the mercy of how that stock performs. If that stock fails and if it drops in value significantly, you could lose some or all of your money. If you have your money in a mutual fund that holds a larger number of stocks, let's say like is listed over here, then you have a shot that some of those stocks will go up and some of them will go down, and the hopes are that more will go up than go down, and the overall performance of the fund will be positive over time, and you'll have a positive return. And again, there's less of a chance that every single stock in a mutual fund holding several hundred or several thousand stocks will go down than there is for an individual, which is one stock, to go down. So that's how diversification helps to counterbalance any effect of a single stock on your portfolio. Now, that's not to say that mutual funds are always safe and that this kind of diversification is the kind that will always keep your money safe. That is far from the truth, because in down market situations, or what are called bear markets, the entire market could actually fall and come down. And that will bring all stocks, essentially, or most stocks, down in price. And that will, of course, drive mutual funds holding stocks down in price as well. So there's always a risk of that. Market risk is always very real when you're investing in securities for whatever particular market that happens to be. Shares in a mutual fund are split to the 1/1000th of a share, so 1/1000th, which means that you could end up putting your $3,000 into a fund and getting for that $3,000 32.8542 shares, let's say. And that's different from individual stocks. Individual stocks are only sold in whole shares. Typically, you have a minimum depending on your brokerage firm. Sometimes you could buy one or two shares depending on the stock. But for mutual funds, you have this potential of having these fractional shares, which is fine. That's just the way they do it. At the end of each trading day is when a mutual fund calculates the value of its shares. And they do this by calculating something called the net asset value, or NAV. And the net asset value is actually equal to a formula, so we can actually write it down. It's the market value of the securities that are in the mutual fund. So that makes sense, right? It's everything that's in the mutual fund has a value. If it bought 500 stocks, then those stocks have a value. They add all those up, and that becomes part of the calculation. Then they subtract fixed assets, and that just comes from the balance sheet when they're calculating these net asset values. Then they add cash, whatever cash they're holding. Mutual funds are not always invested at 100% because sometimes they're just getting cash in all the time from investors. So there's always some cash on hand. And so they add that to the numerator of the NAV equation, and subtract total liabilities. And these are, again, back to the balance sheet. These come from debts that the mutual fund owes, like if they are holding some dividends that stocks have paid them to pay to investors, that's a liability. If they're need to, and any kind of monthly or ongoing expenses that they might have, utilities, rents for the buildings that they're in, employee wages, expenses that they track on a quarterly basis, those are all liabilities that they have to track. So that all of that is in the numerator. And then the denominator of the NAV equation is simply the outstanding shares of the fund. And that gives you this NAV, and it could be like, depending on the fund and how long it's been around and what the assets are in there, you could have an $8 NAV, or you could have a $10 or $50 or $150. It's just a math calculation, and you buy the fund based on that NAV price. Now, some funds have what's called a sales charge, and so they add that to the NAV, and that's called the public offering price, or the POP. And again, that equals the NAV plus a sales charge. And that sales charge is sometimes referred to as a load. You may have heard that, and you may have heard, of course, of no-load mutual funds. And when you hear people say this is a no-load mutual fund, it means they do not charge that sales charge. So that means that if it's no load, then the POP will equal the NAV, and investors will then be able to buy shares at the NAV. If there is a sales charge, you buy shares at the POP. And POP and NAV are similar to when we talked about in our stock video, we talked about bid and ask. If you remember, then the bid price is lower than the ask. In this case, the NAV price is lower than the POP. And investors buy shares at POP and sell shares at NAV to the mutual fund company. And that's just the way it works. And again, that's the way for the company to make a little bit of money on those trades, similar to the way bid and ask work on stocks. But again, remember that if there is no sales charge, there is no load, then POP will equal NAV, and that's where you will buy or sell your fund at. So some mutual funds have sales charge, some don't, but they all have what's called an expense ratio, or expenses that are calculated based on things like what the management of the fund costs, like the fund manager has to be paid. So that's usually a big percentage of what the overall expenses are. And other factors, other things that come into expenses to run a particular fund are factored into that. And that's all kind of summed up and totaled in something called the expense ratio, which equals total expenses divided by average net assets. And for some funds, they'll be as low as 0.01% to like 0.05%. Those are very low. And they could be high. They could be as high as like 2 to 3 to 5% or higher. There's a big difference between those different ends of the spectrum for expense ratios on funds. One thing that's different about how mutual funds trade is that when you enter an order to buy or sell a mutual fund during the middle of the day, that order is not executed until the end of the business day. The mutual fund company calculates the NAV at the end of the day, and the NAV back here is again based on the market value of the securities held in the fund. So they have to wait until the end of the day to see what price those stocks closed at in order to do that calculation. And that's why mutual funds are purchased or sold or traded at the end of the day after that NAV is calculated. So you can put in an order at 10 a.m. I want to buy, $3,000 worth of this mutual fund. That's only going to trade after the end of the day once they know what that day's NAV was. Unlike stocks that trade continuously throughout the day. Investors have a huge number of fund types to choose from different investment companies like Goldman Sachs. You may have heard some of these names that are really important, highfalutin names in the industry. Fidelity, Vanguard, BlackRock. There's all kinds of different companies out there selling or offering mutual funds in many, many different categories. So I'll just talk about like the major categories because there's just not enough time to talk about everything here. There are a couple of major categories for mutual funds, and those are equity or stock. These are, whenever you hear somebody say the word equity, don't be afraid, it's just stock. And the other category is fixed income. And fixed income, we talked about some of those securities already. These are things like bonds or debt instruments that we talked about, right? So those are the two major categories. And under each of those, there's a whole slew of different subdivisions in different categories that you can look at. On the equity side of things, the best way to look at it is by doing a 3x3 matrix. And this matrix is used by mutual fund rating companies as well to kind of give you an idea of where a mutual fund sits inside of this 3x3. Okay, so let's just draw that out. And the way they do it is that they divide that they do on one axis they do size or the types of stocks that are in there. So it could be large cap, and these are large capitalization, market capitalization that we talked about earlier in an earlier video. Mid cap companies with a mid-size capitalization, and small capitalization. And then on one side over here, they'll have value. And on the other, they'll have growth. And in the middle here, there'll be a blend. And let's just call that BL. And when you go look at these mutual funds in different rating sites, you'll see that, you'll enter the name and they'll say, oh, that one fits into this category, or that the one that you're looking for fits into this category, right? So that gives you a good way of telling where your fund is located on this 3x3. On the value end, I should explain, these are stocks that are typically lower in price to earnings ratio, and price to earnings ratio, or PE, is a measure of the stock price over, as it says, the earnings for a company. And in value companies, this tends to be a little bit lower than typical or average, because these value companies tend to be what are called undervalued. They're supposedly good deals in the marketplace, and there may be many different reasons why they're undervalued, but that's where they are. They're low PE stocks that look like they're good deals, so they call them value stocks. On the growth side, so that's value. So on the growth side, you have high PE. So over here, you got high PE. And over here, you have low PE. And high PE indicates a company that is in favor, that the market really likes the company so much that they've given it a very high price to earnings ratio. So maybe their earnings are not where they should be for the price they have, but the market is saying this company is worth more than what the earnings indicate because it has a lot of potential, it has a lot of growth potential, it has a monopoly in its space, it's the leader in its space, or many other reasons why a company might be treated as a market leader. and the market will reward that by giving it a higher PE. Now, growth companies on this side will actually do better as the markets are going up, as markets are rising, or what are called bull markets. And during bull markets, these growth companies can get higher and higher PEs as investors have more confidence in the market and confidence that these companies are going to do very, very well over the long run. On the other side, the value stocks are going to be things that do better on a declining market. So when markets are coming down or reaching near a peak or heading into a bear market territory, value stocks are going to do better because investors are thinking then that growth stocks have reached their peak. There's no more room left for them to go up any higher. So then they'll start shifting their money into value stocks that they feel might be their turn to now go up in price. And because they're value stocks, they feel like their price hasn't appreciated to the point where it should be. And so they feel like maybe that's a good buying opportunity. Now, again, whether or not that's true, it depends on a lot of other factors. So don't take that as a standard fact that value stocks are always going to go up during a downturn and growth stocks are always going to go up during an upturn. There's always exceptions. Again, this is all general information. Work with a financial advisor for you on specific things before you take any action. And as the blend column implies, blended means you have a blend of both value and growth stocks within the mutual fund. So again, you can look out there amongst all these different investment families, different investment companies. They'll have tens, dozens, or even hundreds of mutual funds that fit into this 3x3 matrix. An interesting way to further diversify, so we just talked about diversification in the first part of the video. An interesting way to further diversify is to put your money into these different segments, into these different parts of this 3x3. And so you might want to put somebody here, somebody here, somebody here, somebody here, somebody here, somebody here, and so on and so forth, because what you're doing there is you're spreading the risk again, and you're spreading the risk that if the market goes from an upturn to a downturn, at least you have some value stocks to help shore up the fact that the growth stocks are about to come down, and vice versa. Now, not every investor can do that, of course. You're going to want to have several $100,000 to invest in order to start splitting up your money like this. If you have less than that, you're going to want to do something very simple. And I'll get into that in a future video where I talk about how you start for the young investor. But in this, I just wanted to mention that kind of diversification is there as well. And again, even if you diversify that way, it doesn't mean that you're completely safe from downturns. If the market goes down negatively, in a significant way, all stocks will go down no matter where they are in that grid, or all mutual funds will go down no matter where they are in that grid. It's also important when you're looking for this kind of diversification to look at the top 10 holdings of a mutual fund. One company might say, we have a mutual fund here that is large cap growth. And another one might say, we have a mutual fund here that's mid cap growth. But then if you look at the holdings of the company, they might have the same number of stocks or the same stocks themselves as their top holdings. Like at the very top, like their top, let's say 50% of holdings might both be, for both funds, Apple, Microsoft, Tesla, Google. I misspelled Tesla, but you get it. Google and Amazon. And if you see two funds or more that their top holdings are stocks like that, then you're not diversifying, right? You're basically saying, I'm going to put my one piece of my money into here and another piece of my money into here, but they're holding essentially the same thing. So that's not diversification. So what you want to look for is funds that are orthogonal, what I call orthogonal. And I borrow that term from mathematics. In mathematics, when two things are orthogonal, it means that there's no relation from one to the other. So like on a graph, when you have two lines going off in orthogonal or perpendicular directions, nothing in this line can be mapped to anything in this line because they are completely independent of each other and they'll never cross each other. And that's what I mean by orthogonal funds. Look for funds. If you're going to diversify, look for funds where the one that's holding these stocks, the other better not be holding any of them. Or if they are, it's very few. I mean, you might not be able to find perfectly orthogonal funds, but it's best to look for things like that are that way, that where if one fund is holding a set of stocks, you want the other fund to be holding a completely different set of stocks. And that is true diversification across mutual funds. Again, that's just a quick side note on orthogonal funds. I don't know if anybody else uses that term, but I like it because I'm kind of mathy, and it's a good math term to apply to investments and stocks and mutual funds. So look for orthogonal funds. There are fund rating companies on the internet that are available, and they have a lot of good free information. You can also sign up to be a subscriber to them and get additional information. Let's take a look at one that's out there. It's called Morningstar, morningstar.com. So I'm here on morningstar.com, and I'm going to put in a search for one of the mutual funds that I know about that's out there. VIGAX. You can enter the name or you can enter the symbol. In this case, I know the symbol. And this is the Vanguard Growth Index Admiral Mutual Fund. And this particular fund is part of the Vanguard group of funds. Vanguard offers hundreds of mutual funds to choose from. This one happens to be one that is a large growth mutual fund. So it would fit into this part of the 3x3 over here. And right off the bat, you see that Morningstar gives you some really good information right here. So it tells you the NAV, what the closing price was the last day it traded, what the total assets are that the fund hold, what the expense ratio is. This is an index fund, and we'll get into that at the end of the video. But because it's an index fund, it's low cost. It tells you it's a large growth fund, as I mentioned, how long its manager has been around. The longer the manager has been around, the better. The investment style, again, that 3x3, this is a large growth, and other factors. Turnover is an interesting one that we should talk about. So fund turnover means that, in this case, this fund turns over 8% of the stocks that it holds on an annual basis. So that's actually really good and really low. And what that means is that 92% of the stocks that this fund holds are held every year and are held for years, as opposed to being sold within a year. And that's going to be important for tax purposes. I'll talk about that a little bit later. The other thing to look at here is, again, on the portfolios page. If you click on that, you'll see the portfolio holdings. Again, it gives you an idea of where the fund is, what it holds. 98.5% of U.S. equity stocks. That makes total sense because it's an equity fund. Almost everything is in equities. There's nothing in fixed income because it's not a bond fund. And all kinds of great information in here. It gives you, back on the quote section, it gives you analyst ratings, which you have to sign up for to get, but you can also get things like its growth over time, how it's done over the years. Of course, lately everything has come down. If you're watching this in the first half of 2022, we're into a bear market, so things will come down, but the hopes are that these things all turn around in the long run. As you can see here, in the long run, you have a positive overall performance. And then it gives you returns broken out by year, and all kinds of good information like that. So anyway, that's morningstar.com. It's a good place to go to learn about the mutual funds that are available. And if you hear about a mutual fund, you can go there and research it a little bit. There are also funds that are called equity income funds. And these are funds that buy stocks or that hold stocks that pay dividends. And typically they look for stocks that pay a high dividends, or they'll invest in preferred stocks. Preferred stocks are stocks that behave almost like bonds, because preferred stock gets paid a dividend, even in companies that don't typically pay a dividend for their common stock. If they have preferred stock owners get a dividend. The share value doesn't appreciate as much as common stock, though. And so equity income will have this goal of trying to generate income for the investor by searching for stocks that pay dividends or for preferred stocks and having those dividends flow into the investor. These typically have a lower growth potential than just plain equity funds because they have this income component, and income stocks or stocks that pay dividends tend not to be growth stocks. They don't tend to go up as quickly as growth stocks. And then you'll also run into sector funds or funds that will focus on a geography, sector or geo funds. And those are things that will own stocks that are either in certain vertical industries like oil and gas or precious metals or specialty things like that, or geographically oriented. So they'll invest in companies that are based in the Pacific Rim, let's say, or Europe, or global emerging markets, that kind of thing. Again, these are just a few examples of the hundreds that are out there. And then one other type that you might run into are called balanced funds. And balanced funds hold both equity and fixed income securities. And fixed income, if you remember at the beginning of this, are the other major type of mutual funds.